Hello, today we are solving October 2023 paper question number 3 part C. Prepare the journal entries in the books of accounts to record the £90 receipt on 15 September 2023. Narratives are not required. So here it says in July 2023 Andreas had recorded a debt owed by Polis as an irrecoverable debt. So when Polis was declared bankrupt, so on 15 September 2023, a check was received, okay, for £90 in final settlement of Polis debt. So here we can see that this is an irrecoverable debt account recovered. So let's prepare the journal entries in the books for the same. Okay, let's prepare this. Now it says that so for this you have to understand how this happens. Okay, so usually whenever there is a irrecoverable debt, okay, it's going to come through the bank. Okay, it was like £90. Okay, it was £90. Now this is going to be transferred to the irrecoverable debt account. Okay, irrecoverable debt recovered account. Okay, this is a thing. So it's called irrecoverable debt recovered account. So you will transfer that, okay, on the credits, on the debit side, and then this is going to be transferred to the irrecoverable debt recovered account. It's a closing account. Here you will open temporarily, transfer it and transfer to the income statement, and then you will, okay, you will transfer to the income statement and close it off. So Polis, which is nothing but the trade receivables account. Okay, this is nothing but the trade receivables account of Polis. So it's going to be transferred to, it is going to be transferred to this account. The value is 90, and then this is going to be transferred to the income statement. So this is how it happens. Okay, so you should remember this. This is how the transfer for irrecoverable debt happens. Okay, so it is coming through the bank, then it is transferred to the irrecoverable debt account from on the debit side in the trade receivables, then it is transferred to this here. Okay, and then it is going to be transferred to the income statement like this. Okay, so this is how the transfer happens. For this, now let's enter the journal entries. So the first one we see, it is the Polis account. In the Polis account, okay, Polis account and bank, there are two things, okay, which is going to reflect. Now we can see that in the Polis account, bank appears on the credit side. So let's write 90 here. Okay, so let's write it is on the bank, is appearing on the credit side. Okay, in the Polis account, and bank, in the bank, Polis account will appear on the debit side. Okay, it has come into the bank. Then we can write the journal entry between Polis and irrecoverable debt transfer. So in the Polis account and irrecoverable debt recovered, okay, account, the double entry will be so you are having it on the debit side 90, and so you will be transferring it to the irrecoverable debt account 90. Then irrecoverable debt account, okay, and income statement. Okay, there it is going to income statement. So it is statement of profit or loss. So in the irrecoverable debt account, okay, the income statement, it is appearing on the debit side. So I will write it as 90 here. Okay, and in the income statement, it would have appeared as an income on the credit side. So 90. Okay, Next, state the 4 ways in which Andreas might use credit control to reduce the possibility of incurring irrecoverable debt in the future. So, how to avoid irrecoverable debt? So, you can place a limit on the value of goods supplied on credit to customers, okay, by checking their history. So, you are going to place a limit, only that much of credit I will give it to that customer. Then you can also issue invoices promptly and ask for regular payments statements, and provide regular statements for outstanding debt so that they can pay you back. Then also you can charge an interest on overdue accounts, and you can also threaten them with a legal action if the debt is going to remain outstanding for an extended period of time. So these are some of the ways in which you can these are the credit control policies adopted by the business to reduce irrecoverable debt. Then evaluate Andreas selling goods for cash. So what are the positive points are, so when you are selling goods for cash, you know cash flow problem will be solved, and there is no chance of irrecoverable debt, okay, which we have discussed. So now the cash flow, it is received and there will be no irrecoverable debt, and so it will save the time and the cost, okay, for the business to recover them. But the negative points are, so not all customers will be able to pay with cash. Some of them may not have cash immediately. So that means that your sale of goods would reduce, okay, for those people who don't are unable to pay to the cash. And these customers might also go to buy from a competitor who is offering on a credit goods. So you might lose some sales, and also you will have security issues when you're collecting the cash. So it means that you will have large volumes of the cash, and very often you have to go to the bank to deposit. So there also time and cost involved. So in conclusion, Andrea should not sell all the goods for cash only. He should have credit